Does whole life insurance actually work? When we look at a real policy that was purchased with the intent of maximizing the cash value, that's why you took that policy out, does it work? In this video, we are going to look at another policy that has been issued a little over 5 years ago. We'll get to see what was originally projected at that time and then how it has been performing. Let's have some fun with this one. So in our last video, we looked at KM's policy, which was a policy started in 2017 with Mass Mutual, and that is performing quite nicely. Here we're going to look at a different policy for a gentleman with the initials of CL. He started a policy with good old Guardian, one of your major mutual companies, which has a lot of PUA flexibility, and their guaranteed values tend to look very strong when we compare them to other carriers. That was a point of attraction when we looked at them. Now with Guardian, what his specific plan was to start off with a large lump sum of $300,000 in the first year. Policy design was very, very important to him. Of that $300,000, you'll find that his minimum premium, his base premium and what he's committed to, is about 10% of that, $30,000. You'll see the exact dollar amount when we pull up the original illustration, and we'll see his policy, annual statements, everything. But his minimum commitment was about $30,000 with the ability to go up to $300,000 per year. So he's got a lot of flexibility there. I want to add something very, very important here. It's not super important, but it's good to be aware of because often it creates questions among policyholders. Is he backdated the policy? Now, when you backdate a policy, what's important to note is if you're making a large payment or payment of any dollar amount, when you backdate, the base premium payment is applied based on the policy date. So for example, the day of shooting this video, it's July 1st. Let's assume that you start a policy and you backdate it to January 1st, beginning of the year. Let's assume you pay in $300,000 and your base premium is $30,000. Everything else is directed toward PUAs, minus the term rider. So what would happen here? So again, you're starting today, July 1st, for this example, and this is going to tie into exactly what happened when you look at his actual values. This is important. However, you're going to backdate the policy. Let's go to a different color here to January 1st. What happens here is the base premium dollars are applied based on the policy date, which would be January 1st. So all dividends and interest that would be credited based on the premium dollars are applied January 1st. So you don't lose any time there, which is nice. The thing about base premium dollars is typically they don't generate any cash value in the first year. So it's like, all right, that doesn't really matter. PUA dollars, however, if we are backdating a policy when it comes to PUA payments, or the other, let's just call it $270,000 for the sake of this example, PUA payment. Even though we backdated to January 1st, if we start the policy July 1st, that's when we physically send the money to the insurance carrier, crediting based on the guaranteed rate and any dividends will be applied on July 1st, meaning PUA payments are not backdated to the policy start date. So sometimes what this can result in is I see an illustration that projects $10,000 in projected cash value at the end of the first year, and then I receive my annual statement and my actual cash value is $9,700. I look at it and say, okay, why the discrepancy? Like, why do I have a little bit less money? Well, the specific reason in that example would be a result of the backdated PUA payment being applied to the policy later than what the illustration projected, because illustrations assume all payments are made at the beginning of each year. It's interesting just when you see how everything works. So, hope that made sense regarding the backdating. It's good information to be aware of if we're tracking our values, actual performance compared to illustrated performance. Let's take a look here. So again, he started his policy with Guardian. What we will begin with here is the original illustration. Now take note of when he started the policy. What do you notice up here? Based on the 2018 dividend scale. So the question is, if I'm you watching this, I would ask, well, what was Guardian's dividend rate back in 2018? Let's take a look, shall we? Dividend interest rate is as follows. So let's go back to 2018. what do we notice here on the left? I'm in the way right now. I'll get out of the way. 2018, when he started the policy, the dividend interest rate was 5.85%. So what this means is when we go back to the illustration is going to assume that that dividend interest rate of 5.85% is credited to the policy forever. Now, in reality, does that happen? Or I should say, did that happen? No. Dividend rates always adjust over time. This is why tracking the actual performance is important. The good news here is with Guardian, they were 5.85 for 2018 and 2019, and then 2020 through 2022, they've been at 5.65. What's really fun about this is when we track policies that have been started or been issued, let's say 2018 or even 2017, and people have stayed the course. In some later videos, some later case studies, you'll see this. When they stayed the course, meaning they paid the exact dollar amount they'd originally planned on, the original illustration and actual performance is so close to each other. It's about a 20 basis point difference, which is based on the 20 basis point reduction in the dividend rate. But that's when we look at actual performance there. But point is, the illustration, I'm throwing too much extra information in here. The illustration we saw is based on the 2018 dividend schedule. So let's go back to that. And this is a good illustration to start with because this represents plan A. He had a couple different plans or projections he would like to see with respect to what he hypothetically might do with his policy. When I say hypothetical, he has different funding plans. He might max fund it for a while. He might not. He wants to see what it looks like. So before we go down year over year, let's take a look here. Where is the money going? Here's his premium, $27,000 and change. That is his underlying base premium dollar amount. It purchases him a whole life death benefit of just under $900,000. Now, he's 52, received a preferred plus health rating, okay? We've got this large term insurance rider attached. Here's the cost of the term rider in the first year. If you're new to whole life insurance, the purpose of a term rider is it is a cost-effective method to raise the death benefit. And if you say, I don't care about the death benefit, I'm interested in the cash value, the death benefit, the net or total death benefit, has a direct relationship to a MEC limit on a life insurance policy. The MEC limit is that taxable line. We want to prevent a modified endowment contract from occurring, and how we do that is by not exceeding the MEC limit. Unless, of course, we banked on MEC rollover space. We've got other videos on that. Otherwise, I'll talk about it. So his MEC limit is just over $300,000. In fact, it's about $303,000 and change. You'll see what I mean when you look at his actual funding. But planned funding here. So he's committed, what I'll say first, to these two. The base premium and the term rider. What he actually scheduled for his regular annual commitment is $31,800. What he wanted to do was cover the base premium each year plus the cost of the term rider. Now his term cost has come down each year because he's been piling money into PUAs really in the first 2 years. But he said, hey, I always want to cover the term rider. If I round up here, everything above the term rider cost goes into PUAs. I'm good with that. So he commits to the minimum and can make additional funds at his discretion. When we look at this illustration, so something I want to hit on here, and in our intro video, what was that last bullet point that we mentioned, or close to one of the last bullet points? First 2 years. If you max fund a policy, particularly in the first 2 years, it can really ensure success when we look at the internal rate of return, break-even point. When the insurance expenses are heaviest during the first 2 years, if we're able to max fund a policy, we will see an early break-even point in 99% of cases. The 1% where that would not occur is if I have severe health issues or there's something else with the policy that's outside of the norm. Maybe I'm older, have a health issue, I'm a smoker, something like that. But here, let's take a look. What do we notice here when we take a look? Net premium. This represents the net payments that he wanted to see. This is the original projection. $300K in the first year, He pays in $300,000. $265,000 was projected. Keep that in mind. That exact number right there. You might want to jot that down, 265. But no matter how I slice that, it's about a $35,000 hit in the first year. When people ask what are the drawbacks to whole life insurance when I'm interested in the cash value, that's the number one drawback right there. And this is a policy with the premium minimized. No matter how low I drive that minimum premium, doesn't matter. The premium does not show up in cash value in this product in the first year, with traditional products the first and second year. Some products you'll see more cash value up front, 90 to 95% if it's a higher cash value product, but the worst year is the first year. The next year, he pays in $200,000 in the projection. So he's gotten a total of $500,000 into the life insurance policy during years 1 and 2. He's got $472 in cash value. But here's something I want to point out here that's valuable to be aware of, and it highlights the insurance expenses. If he earned 0%, if it was just money going under his mattress in year 2, if you add $200,000 to $265,000, what would you have at 0%? You'd have $465,000. He's got $472 here. So he sees a gain with respect to his cash value on that isolating year 2. He got more money back than what he paid in year 2. This is a reason. The reason for that is the base premium payment came back to cash value, started to earn dividends. Things got better and better. Now, this is an old product with a lower PUA fee and a guaranteed rate of 4%. The new product, Guardian's updated version of this, performs very close to that, but not quite. A lot of times in year 2, still slightly behind. Year 3, what do we notice? He pays in just the minimum premium in this projection. And it continues to grow, but here's really what I want to hit on. Look at this column. Year 4, in this projection, he's paid in a total of $554,000, and there's his break-even point projection, $556. And he has not max funded the policy year in and year out in this example, just the first 2 years. Well, the second year, he's still heavily funded. He popped in $200,000, where his base premium is a little under 30. That's still a heavy fund when you look at the premium to PUA ratio. But because of that, those first 2 years here, that's the key. That's what got his break even as early as he could get it with this particular product. His plan and what he has been doing is heavily using the policy. He owns a business, has been successful in real estate. Like, he wants to use the capital, not just park money and let it sit and grow. Great bank alternative. You've got the tax benefits, liquidity, all of that good stuff. So this again was the original projection. Let's take a look at what actually happened. So we've got some annual statements here, which are important. And I'm not going to spend a ton of time on this. What I want to touch on is this will display his actual value. So we've got the projection, and then we've got what actually happened. I spent a lot of time in the beginning describing backdating and the impact of PUA payments. He backdated his policy several months. I forget exactly how long it was, but it was a long time. And here's why I mentioned that. On that projection, what was his first year cash value? $265. What is his actual cash value here? It's about $262. So the reason why this occurred specifically is a result of the policy being backdated, and the large PUA deposit of almost $270,000 was applied closer to year 2 than it was year 1. It was not applied on his policy start date because of backdating rules and how that works. Good awareness tip. When I see a little bit money less than what I was banking on or what I thought I should have, like, people notice this kind of stuff. I do, like, it's your money going into the policy. I want to know how it works. So the annual statements, when you look at the Excel spreadsheet we have, we're at to pull up where we got the actual values because we're in 2022 right now. So we pulled it from the from the annual statements. There's the cash value, same thing with the death benefit. And if we look at this, here's year 2021. We've got his current cash value, assuming no loans are outstanding. He used the policy in this year. He's been using it. Net cash value is about 190, okay? And that was several months ago. So let's take a look here and have some fun. So what do we notice? On the left, you've got the original illustration, which is option A. Option A is what we just looked at. Specifically, years 1 and 2, 300K, then 200K, total payments, break-even point, highlighted in yellow. That was the projection. So he was banking on a year 4 break-even point. We looked at different companies, and that was appealing. The long-term performance is there when you look at well-designed policies with the major mutuals. It's there, like we see it deliver all the time for corporations, for individuals, banks. Banks don't use whole life insurance, but when they purchase bank-owned life insurance, they use the major mutuals because we see the performance there. They see it, I should say. But when we look at this, because the long-term performance was there, really it was, well, why not maximize the upfront so I can have more access to equity for opportunities, because that's where I really drive my net worth, where I drive it north. Like that's the name of the game. This is great long-term, but like I want to use my money now instead of having to wait several years. So that's option A. You'll notice here, after year 7, there's a death benefit reduction. What we did here was cut the term rider. We did look at some projections with keeping that term rider, but here so far we're still planning to cut it. Year 7 or year 8 has not come yet, so who knows if we'll actually do it. Over the review calls and review meetings, we will discuss it. Then option B, what's it look like if I really fund this bad boy, right? When I say that, 300K year 1, 300K year 2, all the way through year 7. If we just stuff the thing, well, what happens is it still breaks even year 4, which would be 2020, where he would have paid in $1.2 million. 1.212 would be his actual cash value. We actually would need to make a tweak to the design to do that, where you see about $550,000 more in death benefit. So it's a projection we considered, but obviously did not look at it, and you can tell from his net death benefit, or did not pursue it. He said, let's just keep it at the $5 million death benefit over here. Let's move forward. So, started his policy. Let's see what actually happened here. So, what I will do is get rid of that middle option here. This will be beneficial. Let's delete that. Get the annual statement values on the right. Let's make this a little bit bigger. All right. So, what do we see here? Actual values. Year 1, did he pay in $300,000? No, he paid in just over $303,000. Funding right up to the MEC limit. He was able to do that, stuff the policy. Still, year 1, now we see it side by side, I've got about $262,000, whereas my projection was $265,000. So I've got $3,000 less, and I paid $3,000 more in. What's with the $6,000 delta there? Well, the reason why is, again, because he backdated the policy, and the majority of that payment was in PUAs. The PUA payment was applied to the policy on the date the money was received, whereas the base premium was backdated over 6 months. Again, I have to go back and reference it. It was more than 6 months based on when we submitted the application and when he was approved. But that's why the first year spread exists. And we see the IRR is close to a negative 14% hit, whereas the projection was just under a 12% hit. Now, as time passes, what do we see here? Year 2, the original illustration is no longer valid. And here's why. The dividend rate's the same, but he paid in $303,800. He max funded it. The original illustration assumed that he paid in $200,000. So he's gotten more money into the policy than what the original illustration depicted. And what's interesting about this, so you're at 607 here, total in, about 570 in cash value. There's your IRR in year 2, the annual IRR. So if it's positive, when we isolate that payment, you got more back than what you paid in. Over here, it was 1.59%. If you make a lesser PUA payment, if you pay less into PUAs, you will see on that specific year, the internal rate of return on a policy is typically a little bit stronger. And the reason why is because of the PUA fees or loads. Some companies refer to them as fees. Some companies refer to them as loads. But the point is, the specific year I make a PUA payment, if I look at a max PUA versus a policy with a minimum PUA or no PUA, the annual IRR will be stronger for that specific year with no PUA payment. However, long-term, really starting the next year, if I've added more funds into PUAs, I'll see a stronger overall internal rate of return. Annual IRR the next year and average. Hope that made sense. Let's look at year 3 to demonstrate this. So you can see it here quite nicely. So year 3, what he actually did was paying $31.8. That's his minimum premium plus the cost of the term and a little bit of excess going into PUAs. That's what he actually paid. The value from his annual statement, $620,000 and change. Net death benefit, $5 million. So the policy was $569, call it $570. He paid in $31.8, so he got that back, plus another 3.11%. That's the annualized IRR. So what he earned that specific year if we isolate the growth. The dividend rate that year was 5.65%. So the dividend rate is a gross rate. Obviously, it did not grow by that much. It never will because it is a gross rate. The annual internal rate of return is what I want to see. Year 2, I see a similar pattern here. Now at this point in time, there you go. I said year 2. Year 4, he breaks even, just as was projected. He's got a total of $671,000 in the policy. That's how much he's paid. And what's his cash value? $672 and change. So total input, or call it cost basis, input, premium PUA dollars, $670. There's your net value. There's the IRR. Dividend rate has come down now. We're at 5.65. There's your IRR. Now check this out. Years 5, 6, and 7. He's in policy year 6 right now. But 5, 6, and 7, you're still paying the premium. What's happening with that IRR? Slightly coming down. Then what happens? Check that out. We just made those numbers up. I'm kidding. We never do that. We pull all of this directly from the Inforce illustration software. Why we see that jump on the internal rate of return? Because the dividend's constant here. Everything below this, what's highlighted in beige here, is based on the Inforce illustration, the actual projection. So what's going on, to be specific, in year 8, we exercised what is called a reduced paid up. That eliminates the premium, removes any remaining term insurance, drops the death benefit. So look at this. You see a big drop in death benefit over there. But as a result of removing that base premium, the reduced paid up option, you will, in the majority of cases with the majority of companies, see a nice bump on the internal rate of return. So we get a nice little jump, and this is annualized. We don't have the average IRR here. We can plug it in, but here we just looked at the annual growth rate. And this assumes the dividend remains constant forever. So as we track it year over year, the dividend will change. Guardian's done a good job. The past 3 years, they've been at 5.65, like they're holding steady. But over the long haul, it's going to change. That happens with life insurance companies. You can look at their dividend history. And as it changes, the net internal rate of return will adjust as well. But we see the policy has performed quite nicely, and this is a more recent policy. Started within the past 5 years or within the past 6 years now, but it's been performing really as illustrated, as originally projected, with the only difference here being that dividend adjustment and the backdating, just as far as having less in the first year. That's just awareness on how backdating works more than anything else. But I like to know that stuff up front. I did not always know that up front until I discovered it through working and speaking with life insurance companies. So I hope you enjoyed this video. This was a ton of fun putting this together, which was put together over the years, obviously. If you have any questions on it or anything, please leave any questions or any case studies you'd like to see below in the comments. That does help. I do look at them, and I would love to answer questions or provide any case studies based on what you are asking for or what you'd like to see. And if you did enjoy this, please hit the like button, subscribe for more. And as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.